everybody. Hope you guys are all staying safe and taking care of one another, and also enjoyed part one of our 4-part webinar series. I know you guys received many important gems that Rusty delivered, especially pertaining to interest rates, cap rates, and also the initial effects the coronavirus has had on our market. As you guys all know, the world is fighting the uphill battle against this terrible virus, and we received many emails and calls from our clientele who want to know some of the economic impacts that have transpired from where we are in history. My name is Edward, and I'm the Vice President of TFS Properties. And of course, we have President Rusty Tweed here. And today, we will be presenting to you part 2 of our webinar series, featuring 2 key experts that I've had the pleasure of working with for the better part of this decade. As I mentioned earlier, many of our clients have reached out to us in lieu of the $2 trillion stimulus package called the CARES Act, and some of the other government relief programs that have been made readily available to the open public. The bill itself is 800 pages, and we're working as diligently as we can to extract all of the key data points for our clients. Also, as 1031 exchange specialists, we're eagerly trying to find out the latest details as to what will happen to current exchangers who are stuck in the middle of their transaction. So without further ado, our first segment will introduce our special guest speaker today. We literally brought him on last minute, and we couldn't pass up the opportunity as soon as it presented itself. When it comes time to doing a 1031 exchange, you definitely want a qualified intermediary that has a ton of experience that can also help facilitate the transaction and ensure that there's no error within the tight 45-day window. We use San Diego-based company Exeter Exchange for a vast majority of our own personal transactions. And so I'd like to introduce to you Mr. Bill Exeter, President and CEO of Exeter Exchange. Hey, Bill, how's it going?
Good. How are you doing?
Good.
Good. Well, I thought we'd give kind of a 1031 exchange update, if you will, as to what we've seen out there. And probably the most common question we're getting today is, have the deadlines been extended yet? Have there been any kind of a declaration of extensions? And the answer is not yet. In fact, the president, generally what happens is the president has to declare a natural disaster area. And then from there, the IRS will issue guidance on the extension of the deadlines. And in this case, the president's declared a disaster, but it was under a different act. So we're not sure exactly what impact that has. And the IRS still hasn't issued any kind of a declaration extending the deadlines. We think they're going to. And a lot of the industry trade groups and a lot of the larger qualified intermediaries like us have written letters to Treasury, bringing it to their attention and making sure they're aware of the fact that it's critical. We need these 45 days and this 180-day exchange deadline to be extended, because we have taxpayers who are right in the middle of their 45-day identification period, or they've just passed it, and they can't get out of the house to go find replacement properties. So it's a real issue. So we think it's going to happen. We're just waiting to see exactly when it does, and we'll send out a notification as soon as that does happen. With that, though, it's interesting because we expected almost an immediate decline in our transaction volume. You know, people it's scary times, and people just kind of pull in the reins, so to speak. But our March transaction volume is 23% higher than March of last year. So our transaction volume for this month still looks really, really good. Our pipeline has fallen off a little bit, so it appears to be off a little bit more than 20%, which is actually it's less than what we expected, but we do expect a drop off over the next, say, 3 to 4 months. And that's kind of to be expected based on everything that's going on. But the reaction we're getting from people is all over the board. We still have investors who are working on deals. Lending rates, borrowing rates are phenomenally lowest in a long time. So it's still a great time to buy with the rates down. Sellers really haven't lowered prices yet. So that's kind of an interesting thing. They're not really worried about lowering their prices. But we do have exchangers that are calling and saying, look, I don't want to leave home to look for replacement property. So what am I going to do? And our advice has been, well, don't let your exchange fail yet. Just kind of write it out. We think they're going to extend the deadlines. And then from there, you'll have another 120 days past your 45 days to find property and complete your 1031 exchange. And most of the economists that we've been listening to over the last week or so seem to think it's going to be kind of a V-shaped recession / recovery. We went down really hard, crash and burn fast in just a few weeks. And it should be a relatively, I think, quick recovery once we get past the virus issues. So that's kind of what we're seeing out there in the market today. It's we certainly live in interesting times.
Yeah, Bill, I have a question. If someone's passed their 45 days, like within the last week or two, and they pass the, they do extend it, will it be retroactive to people who have missed the 45-day period already?
Good question, and we're not sure. Usually it is. Normally in the past when they've declared a disaster area, it's been a natural disaster, fire, flood, hurricane, tornado, what have you. So it's a very specific, date-specific disaster. And anybody who's affected by that then gets 120 days on top of that. In this case, it's an ongoing phenomena. And so it'll be interesting to see how they rule on that. I'm thinking that it'll be retro to when this all began, and they'll add 120 days, but it won't be a specific date. It's got to be almost a range of dates, I think, just because of what's happened. So our advice, because we've had clients who have called in and said, I just couldn't leave the house. I couldn't find replacement property. So I'm just going to let the exchange fail. Send me the money. And we just said, I wouldn't withdraw the funds yet. I would hold off because you might get the 120-day extension, and then you can recover your exchange. So don't assume it's going to fail. Let's just kind of be patient and see what happens.
Makes sense. And also, Bill, maybe you could tell our listeners a little bit here. We've all been waiting patiently for you to open up your custodian for IRAs. Have you got that up and running yet?
True. Yep. In fact, we are drafting all of our documents today. We'll be up and running in about 60 days. Kind of a quick history there is we had kind of looked at the 1031 exchange industry and realized, to do it right, we have to be a regulated entity. Less than 1% of qualified intermediaries out there have any kind of government regulation. So we thought we need to do this right. So we spent a couple of years going through the regulatory approval process, and we actually got licensed as a bank. So we now have a trust company in our group of companies, which means that we're one of the 1% of qualified intermediaries that has any kind of licensing, regulation, or government oversight. And that also gives us the ability to roll out other products that are similar in what we do. And so everything we do is kind of a tax-deferred strategy. So we're now going to be rolling out self-directed IRAs where the investor can invest in alternative assets or non-traded assets, such as real estate, mortgages, deeds of trust, tax lien certificates, limited partnerships, etc. So we'll be up and running in about 60 days.
Great. That's awesome.
Exciting stuff. Yep.
Yep. Yeah. Well, we're used to using you guys for years now, and your service has been really good. So we expect the same quality when you have the your custodianship open up.
Appreciate it. Absolutely.
So, Bill, one last thing before we let you go. First of all, thank you. That was a ton of great information coming from, one of the industry gurus that I like to regard as, having seen you for many years. Can you share with all of our viewers sort of your website, how they can get in contact with you? How can they best reach you and your team and your staff as we kind of find out more and more information and news each day pertaining to 1031 exchanges?
Sure. They can certainly visit our website. We have a ton of educational material out there, and that's exeterco.com. So EXETERCO.com. They can email me directly at wexeter@exeterco.com or call our San Diego headquarters office at 619-239-3091. Again, that's 619-239-3091. They can also ask for Mark Turok, who's our Southern California Business Development Officer.
Excellent. Thank you so much, Bill. I really appreciate your time. I know our viewers really appreciate your time. And we look forward to hearing more about your endeavors with your IRA company as well as some news pertaining to 1031s. We
Perfect.
really
Look forward
appreciate
to
it, Bill.
My pleasure. Thanks so
Take care.
much. Take care.
Great.
Bye-bye.
Stay safe.
Thanks, Bill.
Our next speaker is someone that we've had the pleasure of working with for many years, and he's kindly allotted some of his time to us in the midst of tax season and all this chaos regarding the new government tax relief programs that have been announced over the last few days. If you guys have been to one of our seminars or frequently visit the Los Angeles Real Estate Investors Circuit of events, you might recognize this familiar face. Tony Watson is here on behalf of Robert Hall and Associates, one of the leading accounting firms in all of Los Angeles. And he, together with Rusty, will be going over some of the new tax laws that have been recently announced. And we look forward to hearing what Tony has to say. Without further ado, let's jump right into it. Tony, how's it going?
Good. Thank you so much for having me on tonight on today's webinar. And I just wanted to mention, just before we get started, my thoughts and prayers go out to all of the families affected by the COVID-19 outbreak, and anyone and everyone who has been affected and lives have been altered because of what's happening. My heart goes out to you. Our firm's heart and prayers go out to you. So we will make it through this. We will endure this. We will come out on the other side stronger than ever before. So hang in there, follow the rules, stay in place, don't do anything rash, and we'll all get through this together. So once again, thanks for having me tonight. Tonight we're going to be talking about the CARES Act, the Coronavirus Aid, Relief, and Economic Safety Act. Obviously, there's been a lot of questions. In fact, just before we started, I was explaining to Rusty and Eddie that just in a day or two, I myself, one preparer amongst a firm of 15 preparers, I've received hundreds of emails with questions regarding the CARES Act, and there's a lot of misinformation out there. There's a lot of information in general out there, and information will become more available, and the code will be more understandable as we move forward through this. But we're going to go over some of the main points that people have been reaching out to us, questions that people have had regarding the CARES Act overall as a whole. So to start off with, I want to talk about the main points. As a tax preparer, most of the questions that I've gotten have pertained to the stimulus checks. Who's going to receive them? When are they going to be coming? How and what is the easiest way to access that money? Well, I've been dealing with a lot of clients who have been filing 2019, obviously, and I've had a lot of questions about whether or not they need to file before April 15th or before the July 15th deadline now, because it's been extended, in order to qualify for this, or if they can qualify based on 2018's return. And it's either or, to be real honest with you. If your 2018 return qualified based on the phase outs, as you see on this slide here, if you're a single taxpayer and your income is between $75,000 and $99,000, you will qualify for part of the credit. If you're below the $75,000, you qualify for the full $1,200 credit. If you have children, the children also qualify for a $500 credit. If you're married filing joint and your income is between $150,000 and $198,000, you slowly start to phase out from being allowed the full credit. Now, there are calculators online as of now that you can actually plug in your total household income and the amount of dependents you claim, and it will actually calculate if you are between one of these thresholds. It will actually calculate what your allowable stimulus check will be. So there are some really nice tools out there online already that will help you figure out what exactly your stimulus check would calculate out to. But if you're below one of these thresholds, single under 75,000, married filing joint under 150, obviously you're on track to qualify for the full stimulus credit, whether you filed 2019 or not. Now, what you probably would want to do if 2018's return was well above the threshold, yes, you might want to expedite the 2019 filing just to show the federal government that you are below this threshold. Now, there will be some adjustments on the back end, meaning that if you didn't qualify for the full credit based on your income, but then when you file for 2020, the federal government will actually be making an adjustment on your 2020 return that may actually refund you or credit you the difference of this credit that is available. So if you want to dive more into detail about how to figure out what your allowable credit is, you can feel free to reach out to our office, and we'll go ahead and either direct you to the calculator online, or if we can calculate it for you as well, we can go ahead and help you out with that. This is by far the number one question that we've received so far, whether you are self-employed, unemployed at the moment, rental property owners, retirees, basically anyone who files under these thresholds will be qualifying for this stimulus credit. Now, some of the major changes for real estate, I just want to point out, we'll talk about depreciation in a second. I did want to drop down to the second bullet point real quick and tell everybody that carryback losses are back. I think it was 2 or 3 years ago, the federal government had gotten rid of what's called the carryback loss benefit, where under the old tax bill, you were allowed to carry back NOLs, net operating losses, up to 5 years ago, meaning that if you sold a company or sold a piece of real estate 5 years ago for a sizable gain and paid a crazy amount of tax to Uncle Sam, 3, 4, 5 years later, if you had suspended losses that kicked you into having an individual net operating loss, you could make an election. This was under the old tax bill. You could make an election to carry that NOL back to offset gain that was 3, 4, 5 years ago. Well, the federal government got rid of that benefit, and because of the CARES Act, they actually brought it back. So because of this particular situation that we're in, the federal government figured that NOLs from 18, 19, and 20 can actually be carried back up to 5 years. So if 5 years ago you had a massive gain from the sale or disposition of a property outside of a 1031 exchange, obviously, you can carry this NOL back for your business 3, 4, 5 years back and offset tax that you paid 5 years ago. So this is called a 1045 carryback loss, and it is a very complicated tax filing, but it is something that Robert Hall and Associates, we absolutely know how to file and assist with and advise on. So if that is something that triggered a, turn on a light bulb in your head, and you thought, well, yeah, I did actually have a sizable gain 3, 4, 5 years ago, and now because of owning a business that is being impacted negatively by the COVID-19 outbreak, let's go ahead and see if that carryback option is available for you. I think that most people will probably see the massive NOLs at the tail end of this year. Not so much for 2019. 2019 was overall a pretty great year across the board for a lot of people. But starting in 2020, obviously in mid-February when we really started to figure out some of the consequences of all of this, we really started to see what businesses were being impacted by the COVID-19 outbreak. And so I think that 2020 will be the year that we have massive NOLs in 2021 that we can carry back and offset previous year's tax liability. So once again, very complicated tax filing. It's called a 1045 carryback, but this is absolutely something that Robert Hall and Associates can assist with. Jumping back to the first bullet point, something that is, I think, going to be a great benefit for all of my rental property owning clients is the qualified improvement property lifespan is going to be dropping to 15 years, meaning that if you have qualified improvement property, meaning depreciable property that's spread out over 27.5 years for residential or 39 years for commercial, the federal government under the CARES Act has taken that threshold, that time frame, and reduced it to 15 years across the board. Meaning that if I own a $5 million shopping center, and let's say that I have depreciation spread out over 39 years, I can actually accelerate some of this depreciation and take it all as a benefit now. And this is kind of similar to cost segregation, where cost segregation allowed you to do that with some of this depreciation write-off, but without making this election through cost segregation, the CARES Act is actually allowing you to alter the lifespan of QIP, qualified improvement property, and drop it from 27.5 or 39 years for commercial, 27.5 is for residential, and drop it all the way down to 15 years, which for those of you who are a little bit more savvy in the tax industry with real estate deductions, that actually gives you a pretty sizable upfront depreciation write-off. I mean, if you think about it, let's say that your depreciation is $1 million and it's at 27.5 years. Well, I mean, dropping it to 15 years will take a portion of that $1 million and accelerate it so that you can offset current year cash flow and receive more of a tax write-off, increasing your refunds or decreasing liability. And these are all very, very unique calculations that need to be made with a licensed tax advisor, not somebody who is just reviewing your tax returns each year and does taxes in the garage next door, right? This is something that's very complicated and will probably be followed up with special elections made on an individual return. Remember that when you plug these numbers into your system, in your computer system, TurboTax, for instance, it's not going to automatically assume that you qualified for the 27.5 to 15-year depreciation lifespan or the 39-year to 15-year. So what I believe in 2020, when we actually get the software program to prepare taxes next year, that we'll see a lot of these elections being made on the returns to actually go ahead and alter that. Now, as far as going back and retroactively doing it for 2020, you can actually make this retroactive back to February 15th. That's what most of the things that are implemented in the CARES Act, they're retroactive back to the February 15th deadline. But there might be some other parts of the CARES Act that don't follow that guideline. So you absolutely want to follow up with your tax advisor and make sure that you know what date that retroactively carries back for. Rusty, do you have any questions before I move on?
Yeah, well, yeah, that's pretty amazing, the accelerated depreciation. That's kind of like we had years and years ago. So basically,
Absolutely.
any of the regular depreciation you would have had, you just almost cut it in half, which doubles the amount of depreciation you're going to get.
Correct, which also kind of follows into the next conversation. Just when Bill Exeter was here talking about 1031 exchanges, it brings back the point that when you do exit out of a property, let's say 5, 6, 7, 10 years from now, remember that because of this benefit, it is saving you immediate tax now. But down the line, when you sell this property, if you do not do a 1031 exchange, all of a sudden you have massive depreciation recapture amounts. So once again, those of you who are a little bit more savvy with real estate transactions and tax implications of doing so, you have to understand that this is a great write-off for you immediately, but down the line, if you ever sell the property, you will have to recapture more of the depreciation because you've been allowed more of it as a write-off in previous years. So once again, this is a conversation you need to have with your tax advisor on a year-to-year basis, and especially if you are kind of toggling between the idea of doing a 1031 tax deferred exchange versus selling the property outright, taking the cash, and then paying off some other debt or just sitting on the cash. So these are very important conversations for you to have with a licensed tax advisor. Okay.
Yeah, and we're all for doing 1031 exchanges. So
absolutely. Absolutely. Yeah. And once again, the whole benefit of that 1031 exchange is to where you don't have to recapture and pay tax on all of these previous year deductions. Sure, they've been great write-offs for you over the time that you've owned the property. Well, let's keep that going. Let's kick that can down the road through an exchange. So, I always tell my clients, kick the can as far down the road until you kick the can, right? Because as long as you defer that tax while you're still alive, you're not paying any income tax on the capital gain or on the recaptured depreciation on that property. So 1031 exchanges are a great, great tool for you to properly avoid paying unnecessary income tax. So let's talk about another thing that's really, really going to impact a lot of taxpayers this year, and another chunk of the emails that we've been receiving over the past couple of days. What is happening with the retirement plan distributions? Because up till now, the way that distributions from retirement plans have worked is that if you are not 59 and a half and you are pulling money out of a deferred retirement account, not Roth. So I'm not talking about Roth IRAs, and I'm not talking about Roth 401ks. I'm mainly talking about traditional IRAs, 401ks, simple plans, KEOGs, anything that has been a tax-deferred retirement plan. Up until now, if you are not 59 and a half, not only would you pay income tax on the distribution, but you would also pay a 10% early withdrawal penalty on the federal side. And if you're in California, you'd pay a 1% state penalty for pulling it out before the age of 59 and a half. Under this new tax bill, under the CARES Act, you are allowed to withdraw up to $100,000 from a qualified retirement plan without penalty, which saves you 10 and 11, actually 11% here if you live in the state of California, 11% in penalties. That will allow a lot of individuals to access money over the next year to survive on. I mean, this is something that in 14 years that I've worked, 15 years actually, that I've worked in the tax industry, I have yet to see something that gives this much of a benefit to accessing retirement funds. And then obviously you have the benefit of paying it over time, paying it back over time. So you want to talk with your tax advisor about how are there ways under the CARES Act to not pay the income tax on it, but to access the money and maybe pay it back over a certain period of time. And I did want to make a note that you may actually continue to contribute back to the plan without regard to any of the year's caps of contributions. So if you are thinking about still maxing out deferred contribution elections each year through the small businesses, you won't have to, you can actually continue to contribute to that while you are paying this back. But remember, it doesn't have to be paid back within that certain time frame. You actually get an elongated period to pay that back. Once again, you want to make sure that you talk with the tax advisor before doing any of this, because once again, if there is no plan to pay it back, we do want to make sure that in the long term that this is the best financial option for you, because you want to know about your options. You just don't want to go right to your 401k, the retirement plan that's supposed to be something that you retire on, if it's not necessary. So there may be other options out there, especially with the SBA loan division and some of the other plans that the CARES Act has really started to roll out over the past couple of days, that may allow you to avoid having to dip into your deferred retirement plan. So just keep that in mind. Make sure that you have this conversation with your licensed tax advisor. Let's jump into small business really quick. The SBA Paycheck Protection Act, it's called the Paycheck Protection Program, the PPP, that provides up to 8 weeks of cash flow to keep employees on payroll. This is huge because, one thing that I've been seeing online on the news and talking with my clients about, especially in the restaurant industry and the salon industry. I had one client today who was a massage therapist. She literally spent hundreds of thousands of dollars opening up a franchise in Northern California in the Bay Area, dating back to the second month, February of 2019. And she just opened her doors a day before, literally the day before the state of California went into a shelter-in-place order. And she had spent hundreds of thousands of dollars, and she had people on payroll, and they showed up to work that day, and then they got the announcement that they couldn't come to work. So obviously, these types of businesses, they're really being impacted. Now, she did not nearly have 500 employees, so clearly she will qualify for this benefit. This benefit really isn't for larger corporations that have over 500 employees. And the kicker here is that, and she didn't know this when I talked to her earlier, she didn't know that you cannot lay off employees in order to qualify for this. When you qualify for the PPP plan, you have to keep your employees on payroll. And basically what this supplements is that it covers up to, I believe, $10,000 in payroll expenses per employee, as long as you've kept them on payroll or you've done everything to keep them on payroll. And once again, this loan that you're getting from the government, it's forgiven. It's not something that you have to pay back because it is meant to keep your business up and running. It is meant to keep employees working, to keep money circulating in the U.S. economy. And it will cover, obviously, salaries up to $100,000. It's not going to cover salaries above that. And those are the salaries that we really need to save at the moment, are the individuals who are the under $100,000 earners. So, and also one of the biggest things for employers is the extension on the payroll tax liabilities. Those payroll tax deadlines have been extended to January 1st of next year, which is huge. Some firms, some clients that I have with their businesses, even though they're only 20, 30 employees, some of their payroll tax liabilities on a month-to-month basis can be $50,000, $60,000, $70,000. And they're just small restaurants, but it's because of the amount of employees that they have working for their company. So a lot of this information is being relayed to those clients at the moment, making sure that they don't make rash decisions to start laying people off. A lot of misinformation is out there. So remember, to qualify for this, you have to keep employees on payroll in order to qualify for these loans. Now, if you're in the process of going through the layoff side of what's happening, make sure that you reach out to your tax advisor, make sure you reach out to Robert Hall & Associates. And most importantly, one of the best tools online right now is the SBA loan website, where you can actually go and ask questions and walk through the application process to make sure that, hey, if you thought that you weren't going to qualify, maybe you need to think twice. Maybe you need to go through the checks and balances and see what the requirements are, because I find that a lot of the clients that I've talked to already over the past couple of days, because of the situation that they're in with payroll and with income thresholds and whatnot, and obviously under 500 employees, they're finding that they are actually qualifying for this benefit. And SBA has actually added a part to their website that says that this is the most expeditious way to qualify for these disaster loans. So make sure that you know the right links to use. Don't go to third-party vending websites and start their application process, because remember that there's a lot of fraud that's out there as well. So you need to be aware that in times of desperate need and of times of, when people are losing a lot, there's a lot of people out there wanting to take advantage of the individuals hurting the most. So just before anything, out of all of the slides that I'm showing you tonight, just be aware that you need to make sure that you work with reputable sources. Anybody who TFS Properties recommends you to, anybody who Robert Hall & Associates recommends you to, these are companies that we've vetted, companies that we've worked with, companies that we trust. So if you do anything, make sure that you are not just going online and finding the first website that pops up to apply. So just keep that in mind. I didn't want to mention that. Now, before we move on, actually, I wanted to stay on the CARES Act slides for a minute. I know that Rusty had a couple questions for me that we wanted to get answered. So, Rusty, I don't know if you want to hop into those now.
Yeah, sure. Quick question on this. What you're saying here with this particular slide is that if somebody has payroll tax, they don't have to pay any payroll taxes at all between now and the end of the year?
Correct.
But then they have to make up at the beginning of next year.
Well, it depends, because remember that if they are applying for the loans, the small business loans, they might not have to pay any of the payroll tax. So once again, yes, the extension deadline has been moved, but remember that this extension deadline was meant for companies that are applying for these disaster loans. And as the disaster loans kick in, they will cover up to $10,000 per employee in payroll taxes, and they are loans that will be forgiven. And so once again, if all goes to plan for these small businesses, and a lot of people say, well, there's a lot of checks and balances, I don't know if I qualify. Remember that there are a lot of checks and balances, because think about the kind of relief program that was just issued to the United States of America, to over $2 trillion. I don't think people really can grasp the amount of money that just a single $1 trillion is. And so just be aware that if you think there's not going to be enough money out there for you, if there's not going to be enough help for you to qualify for these loans, think again, because this is the most significant upturn of our economy. I mean, that most people have seen. It's a much different recession that we're looking at. It's a much different economic downturn that we've seen. So these plans, there's nothing ever been in play like this before. So before you start to assume anything, make sure you do all of your homework. Make sure you understand that this was meant to keep businesses up and running, and not just to keep them up and running and tie them into debt. This was meant to keep them up and running and to relieve them of paying back the debt. So when you look at these types of relief plans, understand that it covers salaries up to $100,000. But then what I didn't include here, because I only have a certain amount of space, is that they'll cover up to $10,000 in those payroll taxes per employee if you qualify for that. So yes, the extension deadline was moved out to January 1st, 21. And if you can afford to pay the payroll taxes, if your business, once the stay-at-home ordinance is released, if you can get back up and running like an accounting firm can, because once the stay-at-home order is released, we're back in the office. We'll be back to business as usual. But some businesses won't be that fortunate, and so these are the businesses that can actually extend out to the 1st of 21, and then they can also apply for these forgiven loans to cover these very expensive payroll costs that they're incurring. But remember that you cannot be laying off people. This benefit is really meant to keep your doors open while everybody's at home, right? So
yeah, no, that's really great. Very good. I had a question too. We're hearing a lot about mortgage forbearance, where you're allowed to depending on your bank and everything, but you can call them up and say, okay, can I hold off making my mortgage payment for, I'm hearing like 3 to 4 months. If somebody did that, how would that affect, do you think, their taxes at all?
So the mortgage forbearance means that many of the property owners will be allowed payment deductions still, or deferrals on mortgages. And what I've been hearing is actually up to a year. I'm not 100% positive on that, so I will have to do some more research on that. But I've heard that it could be extended up to a year. And when you talk to your banks, all banks are different, right? Now, banks are obviously in it to make money, but during this time, during this crisis of the COVID-19 outbreak, a lot of banks are becoming very flexible because they don't want to lose their clients. They don't want to foreclose on homes, which obviously they can't at the moment. But at the end of the day, I think that what they're saying is that while you are not making your mortgage payments, the interest is accruing, but you're still going to be allowed this deduction even though you're not paying the mortgage. That's the crazy thing. That's at least what I've read. Now, once again, I will have to dive further into detail about the understanding of that. But what you're going to see a lot of people doing is you're going to see a lot of people delaying their payments and waiting until those paychecks come back in. As far as SBA loans are concerned, or adjustments, I think that eventually at some point there will have to be another situation like we had during the last recession, where they will be doing loan modifications. Nothing, I don't think I haven't read anything particular about this, but that usually is what follows a stimulus package. Is the banks have to, once again, the stimulus package will assist as much as it can, but as far as getting people back to paying their large mortgage payments without worry of foreclosure or short selling their property, there will have to be some sort of loan modification benefit that kicks in, and that won't really be a federal government regulation. That will be something that the banks decide to do to keep people in their homes. And obviously the banks are getting a little bit of a kickback from the federal government as well. So I think that in turn, once they kind of do their checks and balances and balance their balance sheets, they'll figure, okay, well, we can afford to do some sort of loan modification for our clients so that they don't lose their homes. But the mortgage forbearance essentially means that they can defer their mortgage payments, I believe, once again, up to a year. If you've heard 3 to 4 months, I've heard that as well. So I would have to do a little bit more diving into research about whether or not it's the 3 to 4 months or up to a year.
Right. No, I got it. Good. And then now the other side of the coin, what happens if you're a landlord and you're now there's all these things coming out saying that tenants can't be evicted and they don't have to pay the rent under certain circumstances. That's going to be a really big negative impact on landlords, and I'm sure they'll end up showing a lot of losses because of that on their taxes this year, which may kick in that carry back loss provision, correct?
Correct. Well, and remember that when you have properties that have, because the properties continue to have maintenance expenses, they continue to have operational costs, mortgage payment deductions, property tax deductions. They continue to have all these expenses, but if the income's not coming in, obviously they won't be paying tax on money they don't receive, right? So there will be less rental income, more expenses. Those losses, if they do end up kicking the taxpayer into this NOL scenario, they can take that NOL with the 5-year carryback, amend their returns dating back 5 years, and offset previous year's liability. Now, what happens? It's like a domino effect. So if you have the NOL this year and you carry it back 5 years from 2000, let's say 19, because you're filing 2019 right now. Well, let's use 2020 as an example. Let's say next year you file for 2020, you can carry the NOL back from 20 to 19, 18, 17, 16, 15. So if any of those years you've shown positive income and taxable liability, this NOL can be carried back. And let's say you carry back to 2015 and you only use 20% of the loss. Then you amend 15, carry forward the remaining loss to 16, utilize the remaining loss in 16, carry forward that remaining loss into 17. So it can actually, the NOL can actually impact multiple years and allow you to access refunds, refundable money, not credits, but refundable dollars from years that you've already filed 5 years ago. So the NOL is a unique tool. Like I said, it's a very complicated tax filing. It always has been, probably always will be. In the past, though, it's been a highly scrutinized election with the IRS. I feel like because of the CARES Act, the 1045 carryback will be the regulations, the restrictions will be a little bit more flexible, because this was really meant to benefit people to get money back into their bank account without having to tap into any more of the stimulus package, because that's already going to be divvied out amongst the different industries and really meant to keep people in their homes. With the rental properties, obviously, without collecting rental income, you're going to have all of these expenses. And obviously, there's a rule here in California, and I'm sure that in most other states now, where you cannot evict your tenant if they're not paying rent. There are going to be a lot of challenges of this, because people who weren't really impacted by the coronavirus, they might say, well, because of the coronavirus, I'm not going to pay my rent. And at that point, the people who are wrongfully just avoiding paying their tenants when they actually can, when their job still is kicking out a steady paycheck to them, there will be a lot of legal battles in the upcoming year, 2, 3, 4 years, probably even longer than that, because of this. These changes were really meant to benefit the people who truly were struggling from the loss of job, the loss of work. Here in LA, we have the entertainment industry, which is on a complete lockdown. Right now, I'm seeing 13, 14 tax returns a day. Even though the extension deadline was moved out to July 15th, we're seeing a lot of these returns coming in. And a lot of our entertainment clients, they're just sitting at home, because they can't go out to a site and film or set up a stage or do sound recording. The editors are still working because they're sitting at home on their computers and editing, doing color timing and whatnot. But there are a lot of people that are being impacted by this. So remember that if you truly were impacted, these are the benefits that you can reach out and grab. But if you're an individual who is still receiving a consistent paycheck, there will be some sort of regulation or some sort of due diligence or checklist of people who stopped paying their rent checks to prove that they were impacted by the coronavirus and by the COVID-19 outbreak. So just be aware of that. It's not meant to just say that everyone can stop paying their rent. And these are questions that we get all the time. Does it mean that everybody can stop paying rent? Some of my rental property owners are very concerned about this. Some of my clients who are working are concerned about this. They're saying, well, what if I just stop paying my rent? What's going to happen? Well, that's not the right approach with this. You got to understand that there are still businesses that are still very much kicking here in the United States. So this is really meant to benefit the people who have truly lost a lot of their revenue and meet the income thresholds and have truly been impacted by this devastating disease or virus. So, any more questions,
It's
Rusty?
going to be tough in some of those landlords, sure. Okay. And then now I also heard about there's some kind of sick leave credit if someone actually got the virus.
Correct. So the sick leave credit is something that is really kind of put into the federal program. It's basically federal paid sick leave, and the employee is entitled up to, I believe, 2 weeks of paid leave. Under the Act's expanded, like it's called the Family and Medical Leave Program. An employee is entitled to 12 weeks of job protected leave, and the first 2 weeks of which are unpaid, and the remaining 10 weeks of which are paid. So, this is something that as far as application is concerned, I believe that we'll have to learn about the application process on that. And I have not dove in far enough into the application process for that. But I believe that there is something that you will do with your employer, I believe, where they will actually pay your paid leave, and then the employer applies for the relief from the federal government. I believe that's how it works. It's not something where you go out and you apply for it. It's something where the employer actually pays for your paid leave or sick leave, and then the government actually steps in and refunds the employer all of that. And I believe that is a forgivable loan as well. I'm not 100% positive on that as well. Like I said, there's a lot coming out, a lot of information, a lot of misinformation out there online. So I'm trying to get the most reputable sources to research and to understand and know about. But I believe that that's how it works. I believe that when an employee is gone on sick leave, and they cannot be terminated if they were impacted by the coronavirus, by the way. So if they actually got sick and they couldn't go to work or they couldn't work from home, an employer cannot terminate them. That's completely the wrong way of handling all of this. So now, obviously, the employer can request a doctor's note. They can request proof of some sort within reason. Obviously, they can't demand things from you and anything that's not reasonable. But there are ways to prove to your employer that, yeah, I am at home and I'm sick because of me being impacted by the coronavirus. But yeah, that's essentially how it works. So it's 80 hours or up to 2 weeks of paid leave. And then if it's longer than that, if it's elongated further than that, then once again, it's something that your employer pays. And then the government, they would apply for the relief program from the government. The government would pay the employer. So that's essentially how that would work.
Good. Well, excellent. Well, that's a lot of good information, and I'm impressed that you managed to get that much out of it in this short time.
There's so much more. There's so much more.
Well, I think Eddie mentioned in the beginning, it's 800 pages deep.
Yeah.
That particular so it's a lot of stuff in there. So yeah, so I think we covered a lot of good points tonight, and I'm sure there's going to be more questions. And if you guys have questions, email us. We'll probably be doing a follow-up in the next week or two with Tony as things roll out to get more updates as more questions come in and there's more areas that need clarification. I'm positive that we're going to need to do that. So yeah, thank you very much, Tony. Really appreciate it.
Absolutely.
And I'll let you get a little caught up in your sleep if you can.
I'm back to preparing tax returns, man. It's tax season.
Yeah, really. Well,
right back to appointments.
That's for sure. All right. Well, we're going to wrap things up here. So thank you again, Tony. And, thank you, folks. Hopefully got some good information of all this. We're actually going to be doing our part 3 in a couple days on Saturday. And on that one, we're going to be taking a trip to Texas. We were there just before all this stuff happened. Literally, we were all in Texas for the whole group of investors. So we're going to be, we have some great footage we took from there and explaining the types of properties, because we've done well over 250 properties in various parts of Texas. So it's really worth taking a look at what we're doing there. And again, we'll be doing ongoing updates as we go along here after this, because look, this whole situation we're in with the coronavirus, it's just started. You know, we've got a curve here to go through, and I don't know, this could keep going for anywhere from 4 weeks to 8 weeks, or who knows longer. Let's hope not. I mean, obviously, the shorter this is, the better that we're going to come out of it, and the longer it is, the tougher it is to get to come out of it. But all these packages that are coming out as far as tax breaks and stimulus programs are definitely worth paying attention to, because that's what's going to really help cushion what's happening here. So thank you all again. And if you want to sign up for our next webinar, which is going to be on Saturday, I believe there's an RSVP on the website here, Eddie, or how's that working?
Correct. So all of our attendees will be able to register for our next webinar, and as we transition here. So what we'll have send out to everybody that's been in this, or that is participating in this webinar, is we'll send you a direct link to sign up for part 3 of our webinar series. If you have any questions for Tony and his dedicated team over at Robert Hall & Associates, or for us at TFS Properties, please fill out this chat room box with all of your questions, and I promise you that one of our team members and one of our staff will get back to you very shortly. But once again, thank you, Tony, for your time and your efforts in getting us all this data amidst all the tax preparations you're busy with on a daily basis. And one final thing is, if investors or one of our clients wanted to get a hold of your firm or someone within your organization, what's the best way they can get in contact with you, Tony?
Best way to get in contact, because we're all offsite at the moment, is to email info@roberthalltaxes.com with any immediate questions that you need answers to. That will be divvied out amongst all of the senior preparers at our firm. They're all working from home at the moment, so it'll go into our portal, and then it will be assigned to a senior advisor, and we'll get those answers to you as quickly as possible. You can also call our office at the 818-242-4888 number, 818-242-4888 number. That might be a little busy right now because we are rerouting numbers to the different preparers in their home offices. So probably the best thing to do right now is just to email your questions to info@roberthalltaxes.com. And then we'll get back to you with the answers as soon as we can.
Great. Sounds good, Tony. We look forward to seeing you again soon.
Great. Thanks, Tony. And night, everybody.